Danny, I have to come clean to you about something.
Oh, what'd you do?
Well, there was a point in my life where I was in so much debt, I couldn't even afford the electricity bill.
Really?
Yeah, it was the darkest time of my life.
Yep. Okay. It was the darkest time. Nice
Yep.
one, man.
Thank you.
You're just always always winning with these.
Gotta lighten the atmosphere a little bit. See what I did there? Lighten atmosphere.
Yeah, pay that light bill.
All right. Welcome back, everyone, to the Financial Philosophers Podcast. Thanks, as always, for putting up with our horrible dad jokes. Danny, we got a cool topic today. We're going to be talking about debt.
All right.
Yes.
I would say debt is not a good thing. It's not cool, man. But yeah, let's talk about it. That'll be great.
Yeah, it's one of those topics that is pretty broad, but today I want to try to pare it down to a more thoughtful thought experiment. So
Sure.
more specifically, I want to explore this idea of paying off or paying down debt as part of your quote-unquote asset allocation strategy.
Okay.
And
for those listening, what exactly do you mean by asset allocation?
Yeah, so before I jump into that more narrow definition, like broadly speaking, making additional debt payments is always going to be a part of somebody's capital allocation strategy, right? Like you have free cash flow. What do I do with this free cash flow? I could do X, Y, or Z. One of those options might be paying off additional debt. So you may go through some exercise to determine whether that's where you want to deploy your capital to paying off additional debt. But more narrowly speaking, I want to explore this idea that you could look at additional debt payments as being part of your asset allocation decision. So what do we mean by asset allocation? So traditionally, when you talk about that topic, it's usually in the context of a portfolio, right? So somebody has like their asset allocation may be some percentage of stocks and some percentage of bonds.
Absolutely.
Or fixed income,
And
right?
and that varies upon your age and how much risk you can tolerate. As people move through life, they tend to move away from riskier assets such as equities and into the bond market for that kind of guaranteed income.
Right. Oh, and quick side note, if you hear the word stocks or equities, those are generally the same thing. To any of our listeners who are not familiar with some of the terminology.
Good call out.
Yeah. So yeah, you're right. Traditional advice is that, stocks are higher volatility, but the expected returns are potentially greater than what you could get maybe in bonds or fixed income or cash-like instruments. And then bonds, on the other hand, are traditionally looked at as lower volatility, and their expected returns are potentially lower than stocks. It's not always the case in any given environment. As we've seen with the rising rate environment, some people have had bond losses or downturns in their bond portfolio.
Yep, and that's something we can go into much later. But yeah, with those longer term bonds, you face that interest rate risk over the long term,
right?
And that's what those banks have felt. That's for sure.
Yeah, and yeah, Danny, that might be something we discuss in a future episode, is talking more about that topic, because it is complicated, especially to people who are not familiar with bonds and whatnot. So, but for today's discussion, we're just going to talk in general, like, people have this asset allocation. It's some percentage of stocks and bonds, like you said, based on their age and risk tolerance. And, an example of some of these asset allocations might be, 80-20 or 60-40. 60-40 is a common portfolio you hear about with like people nearing retirement, like 60% stocks and 40% bonds.
It used to be more conservative. I think that the bond percentage used to be higher, but the 4% rule that everyone loves to quote actually relies upon everyone staying 60% in equities, because you have to have the risk on growth to maintain that 4% rule. And I did look it up. That actually came from the Trinity study in the 90s, not the 70s and 80s like we said before.
Interesting.
Yeah.
I'm not familiar with that. That's but I that makes sense. And also to your point that you just mentioned, that it used to be higher bond allocations in the past. That would also make sense. Again, I haven't done a lot of research before this episode into that, but back in the day when yields and interest rates were much higher, the yield you could get on your bond portfolios was substantially higher.
That's
right?
true.
So
If you're in the 80s with what was it, like a near 20% interest rate, astronomical.
double digit.
Yeah.
Yeah, and for a long time we've been in these ultra low interest rate environments, so I could understand the shift towards a higher stock allocation. But here we are today talking about debt, and how could this fit into this asset allocation, right? Perhaps you, the listener, might find yourself asking, should I invest these dollars I have available, or should I pay off additional debts?
Yeah, and just to clarify that and specify, in terms of this asset allocation, we are focusing and talking about additional debt payments, not your base monthly debt requirement, but additional payments on those debts.
That's an excellent clarification. Yeah, so this is above and beyond what your normal monthly debt obligation payments are. This would be like a deliberate overpayment towards that debt to try and knock it out or reduce the interest you're paying on it. So this is where the thought experiment comes in. Does making additional debt payments serve as an appropriate alternative to otherwise investing in bonds or fixed income or cash-like instruments, right? And the first question that comes to mind is, well, is this a fair apples-to-apples comparison? I would argue sort of. I mean, it takes a little bit of stretching the concept, hence the thought experiment, but paying off debt, if you think about it, it offers a quote-unquote fixed return, similar to the yield or interest rate you might find in bonds or CDs or high-yield savings accounts.
That's very true.
And it's just the inverse, right? Like it's interest you otherwise would have paid had you not paid it off.
Mm-hmm.
It's not like it compound.
You
it's
are
not like it's
you are essentially earning money by saving on the interest you would have been charged.
Right.
So again, it is kind of an inverse, but you are still earning yourself financial freedom over the long term.
Yeah, and you're also compounding your wealth accumulation, right? Because if you're talking about net worth, which is something we should probably talk about in more detail in some episode.
Net worth will be an upcoming episode. Yeah. We'll note it here.
Yeah. But your net worth increases in two ways. One, saving dollars, or two, paying off debts, because your net worth is literally your assets minus your liabilities. And so if you pay down debt, you are literally increasing your net worth, right? And if you are paying off debt with additional payments and more aggressively paying it off, thus saving that additional interest you otherwise would have paid, then you are compounding the rate that you are growing your net worth, if you will. That's one way to think of it. So it's a little bit of a stretch, right? It's the inverse of a yield or interest rate because it's debt that you're paying off. But, you could argue that debt and the bond portion of your portfolio are not so different, right? Bonds are debt instruments after all, right? So the two are not so different from one another than you might otherwise think. So with this concept in mind, you have to ask yourself, is there ever a compelling reason using free cash that you have available to you to choose to pay off additional debts as opposed to investing it perhaps in the bond or fixed income portion of your portfolio?
Yep. And I think that what most people look towards, and if you're going to do kind of a mathematical approach to figure out whether or not that makes sense, then you're looking at your expected return with investments versus your interest rate, right? If you are running an incredibly high interest rate debt, then it certainly provides very good returns to get that paid off quickly.
Absolutely. And that's actually, you nailed the first thing that I would invite listeners to consider is compare the interest rate on your debt to other alternatives available to you. This could be things like, what is your high yield savings account currently paying in interest, or what CD rates are out there right now? If you have money invested in your brokerage account or your IRA or 401k, look at some of your bond holdings, your mutual funds or ETFs. And to our listeners who don't know what those are, they're going to have a ticker symbol. They're an asset in your holdings. And you can actually Google that ticker symbol. It's usually 3 letters for an ETF or 5 for a mutual fund. And you can look up something on it called the SEC yield. And that's going to give you an idea of what what that fund is currently yielding in terms of its dividends and interest. It's a calculation based on the past 30 days. It's usually the best representation of what it's currently yielding. You can look at those numbers and compare it to whatever debt in question you're thinking of tackling, and ask yourself, like, am I getting a better quote unquote return on my investment by deploying my dollars towards additional debt payments as opposed to allocating it towards these other types of options at my disposal?
And you're going to see a big difference with those. I'll bring up my mortgage as an example. I have a 2.75% interest rate, and
that's unbelievable.
I love it. I love it. We refinanced after a few years, managed to snag that interest rate, and now we're never going to sell. But we pay an additional 25% on principal every month, and we're expecting that to shave the life of the loan by maybe 8 years and save close to $50,000 in interest over the course of the loan.
Wow.
But we only put 25%. I'm not trying to pay off the house or the mortgage incredibly early, simply because it's a 2.75% rate on the debt,
right,
versus, not double digit, but very high potential returns over time in the equities market. So that's where most of our free cash flow goes, towards the equities market, not back into the mortgage.
There is so much to unpack in that example you just gave that I absolutely love. And I'm really glad you shared that. I have always had a bias towards paying off debt. Call it emotional, call it a calculated risk mitigation decision, whatever it might be.
Well, there's a clear psychological safety benefit as well.
Yeah. And there, especially at that low of an interest rate, I know people, and I've heard people who would balk at the idea of, like, why would you even pay 25% towards this 2.75% interest rate when you could just be putting it all in the equity market, right?
To be fair, and I also am just like you. I don't actually want a mortgage, right? I don't want to continue paying it. So I think that the 25% is a good balance between early repayment and potential to invest.
Yeah. And you said, you quoted a dollar amount too, right? And this is a concept I also want to explore in a future episode when talking about investment returns in general. But you said save something like $50,000 in interest.
Correct. Yep.
We're talking about
a 2.
We're talking about a 2.75% mortgage, right? But the $50,000 hits so much harder, and that's an interesting phenomenon that I notice with most people, is that most people don't think intuitively in percentages. They're more hearing actual dollar amounts is much more intuitive, and that makes a lot more sense.
Yeah, that makes sense.
So, it's usually a more motivating factor than just quoting a percentage, right? Because we don't intuitively immediately think in that way. So that's a cool example. I actually want to come back to that in just a little bit.
Okay, sounds good.
So compare the interest rate on your debt to whatever alternatives you might have available to you. And that leads us to the second point, which is taking this a little bit further, just a deeper step. Be aware of your after-tax yield or your after-tax return, right? So I want to explore this a little bit and define what that means.
And that applies directly towards investing, bonds, equities, etc., not on the debt side.
Yes, great clarification. So let's unpack this. So I'm going to give an example. I'm just going to use myself. My wife and I are in the 24% federal income tax bracket. And in our state, we also fall right around the 6% state income tax bracket. So you combine the two, 24 and 6. We're at the current marginal bracket we're in is about 30% between the two.
Yeah, I do not miss living in a state with income taxes.
They do sneak up on you. But so to give you an example of how this affects our after-tax return, if we were to put $100,000, which would be amazing to be able to do, into a 1-year CD, just for simple math, $100,000 into a 1-year CD at 5%. At the end of that 1 year, that CD will have grown to $105,000, right? $5,000 being the 5% growth.
Yep.
We would then have to pay 30% tax. Again, these are all estimates for the purpose of this example. It may not be precise or exact, but to demonstrate the point, let's say we pay 30% tax on that $5,000 in interest we earned.
Okay.
That's $1,500. So our net return was really $3,500. So
Okay,
we
that's
put in
fair.
100,000. Yeah, we put in 100,000. It grew to 105. We paid 1,500 in taxes. We walked away with 103.5. So our after-tax return was really 3.5%, not 5%, right?
Okay. Yeah, and
Now,
this does change depending on your personal tax situation, right? For the
Yes.
listeners, it will be different for everybody.
Oh my gosh, yeah. Don't even take these numbers with a big grain of salt, because these are just hypothetical examples to demonstrate a point. Like, again, we keep referencing future episode ideas. There, CD interest is taxed as ordinary income.
Okay.
But then there are other investments that are taxed differently, like long-term capital gains or qualified dividends have
Yep.
different tax rates that apply. So
We'll definitely
concept
dive
here is
into
that
those, because for people
at
on
some
the
point,
lower
yeah.
income spectrum, some of those rates are literally zero, which is
Yeah.
pretty nice.
Yeah, depending on your situation, it might work out that way.
So
So the point of this,
two things on that
sorry,
return, and again, we're going to jump into these later. One thing to keep in mind, I know that's a lot of tax, right, if you're looking at those, but that is tax on money you would have otherwise not had, right? Like
Correct.
it wouldn't have existed. So does it hurt to pay the tax? Yes. But it's better to have that income, right? And ultimately, if your tax situation gets to where it's burdensome, you can start looking into things such as municipal bonds, right? Which, if they are within your state, will be tax-free. And there are a lot of different stipulations, and you have to buy in the state you live in, and we'll dig into that later. But there are ways to get tax-free income in the future.
Yeah, there's a lot of nuance to that conversation to unpack too. It's a complicated topic that we'll have to explore in greater detail. But for purposes of this discussion, the point we're trying to get across here is that your after-tax return, what your effective return really is, may be meaningfully lower than the stated interest or yield that you were earning on said given investment, if you will.
Okay, that's fair.
Yeah, and so, and of course, if you're investing in a IRA or 401k or some other tax advantaged account, this hypothetical example would be different, because you may not be paying taxes on that growth right away, if at all. So for this purpose, though, understand this concept that the return that you think you're getting may not be as high once you account your taxes. So this is after tax return. Yeah. So when you pay off debt, you are getting the stated interest rate of your debt. That is what you're saving. That's a guaranteed number, because that's what the stated debt interest rate is. It's not affected by some after-tax calculation. So to put this into a comparison, if we were putting money in a 1-year CD at 5%, or we had the option to pay off a debt that had a 5% interest rate, they're not equal. One is actually a greater return than the other, and that would be the debt, because the debt is not impacted by some after-tax return concept, if you will.
You're getting the actual return stated, that nominal yield, essentially, right? The stated number percentage that you're seeing. And also,
Absolutely.
I mean, if we're talking 5, 6, 7% interest, right? If you look, my mortgage, if it was at 7% interest, paying it off 10 years early, I'd probably save, well over $100,000, possibly $200,000. We'd have to run those numbers, but it would be an astronomical amount of money.
Yeah, it would be, and we're actually in an environment right now where there are 7% interest mortgages, or close to it, at least at the time of this recording. It's been fluctuating a bit up and down, but speaking of mortgage, right, or certain other debts like student loans, I know we're talking about after-tax returns, but we should also play devil's advocate here and also remind our listeners that it's also important on the flip side to factor in any tax deductions you might be getting on certain debts. like
That is fair, but
student.
I also think that they are overblown. I think that
I agree.
the overall reduction and benefit you get from those deductions doesn't make sense if the purchase itself wasn't a good idea, right? Like it needs to have been a good use of debt, and then the tax deduction is kind of just icing on the cake. It's a bonus.
Yes, I think if we're strictly looking at the numbers and just trying to deploy cash to maximize the dollar, I do think it's important to factor it in, reasons of purchase aside. But I do still agree with your point that they tend to get overblown. For example, let's take student loan interest, for example. Certain people, depending on your income level, is as long as your modified adjusted gross income, which is a topic for another time.
We are getting in the
As long
weeds
as
here. That's for
yeah,
sure.
as long as your modified adjusted gross income is low enough, um, you may be eligible to deduct student loan interest, up to a limit. There's only so much you can deduct, and so um, that could help take a little bit of the sting out of the student loan interest you're paying if you qualify for that deduction. Mortgage interest is also deductible if you itemize deductions on Schedule A when you do taxes. So I'm going to try to, this is a little bit of an advanced topic. I'm going to try to navigate this topic in a way that makes sense to our listeners, both on the side who are well informed on the topic and those who are not.
Yeah.
So,
and just to preface it, most people are just going to take the standard deduction because it's going to be higher than an itemized deduction.
right.
Right. Maybe if you are on a coastal city and you have $1 million+ home and you're paying interest on that, then it makes sense to take an itemized deduction. But for the vast majority of Americans, you're going to be taking the standard deduction. That's what we fall into.
Yeah. I think you more or less just hit what I was trying to broach on this topic. Which
Sorry
is,
to steal your thunder.
no, that was great. You said it better than I could have. And you have two options, either the standard deduction or the itemized deduction. And under the Tax Cuts and Jobs Act, the standard deduction was raised substantially. And so what that means is it's much harder for people to itemize their deductions and clear that hurdle, like get the number higher than what their standard deduction now is under current tax law. And so even if they do itemize their deductions because they have a lot of mortgage interest, maybe they only fall a little bit above the standard deduction. So
yeah, that's fair.
It begs the question, like, are you really effectively deducting all your mortgage interest, or is it just a little bit of a portion that made it above the hurdle of the standard deduction, if you will? So the idea here is don't forget to factor in any tax deductions for certain debts you have if you're eligible for them, but don't overestimate them. Like have a realistic view on them. So those are two important points. I think the third thing is be aware of other benefits you get from paying off debts that you might not get with your investments. So a couple examples would be like paying off your debts might improve your credit score. I don't think that's the case by just making additional.
Yeah, I don't think the additional payments do. It's the continued life of loan or life of account, and those on-time payments. You actually probably over time have a better return on your credit score if you just pay the minimum, right, and have an account. And this is not advice to do it, but if you can show you have 5 years of on-time perfect payments versus paying it all off in the first 6 months, do you think that maybe there's an argument there that it would have a larger effect on your credit score? Again, not suggesting anyone actually take that long to pay off debt.
I don't think so. I think it's complicated.
Okay.
The credit score takes a lot of factors into consideration.
Yeah, utilization
one of which
is another.
That's one of the biggest factors is how much of your debt utilization are you at? Like how much debt do you have, right? Decreasing the amount of debt you have can improve your credit score because it's lowering that percentage of debt utilization. This is especially apparent with credit card debt, which we can talk about in a future episode. But yes, it can improve your credit score. Paying off debt can also reduce the demand on your emergency fund. Here's a callback to our third episode.
Exactly.
Right? Like part of your emergency fund uh, is made up of essential
Mm-hmm.
expenses. Some of those essential expenses are mandatory debt
Yep. Yep.
obligations
Your
if you have them.
minimum debt payments need to be
Yeah,
factored
and if
into
you
your emergency fund total.
yep, yep, and if you pay off those debts, that's money that you theoretically no longer need in your emergency fund that could then be redeployed, right?
Yep. That makes
Um,
sense.
yeah, paying off debt improves certain financial ratios, like your debt to income ratio, which can help with future lending options. It Paying off debt increases your free cash flow, right? You could then use that to invest or save even more aggressively, or do the snowball effect where you can have more money than to pay off other debts. And I think that ties into the next one, which was something you talked about earlier, which was this, you know, psychological benefit, the
Mm-hmm.
peace of mind, which is profound, right? I don't think we should discount that. I think that's an important factor in terms of motivating ourselves to keep making progress
I
on
agree.
our financial journeys.
I agree.
So,
Um, I I'm not paying off the mortgage of our house, right? We are accelerating it, but we're not paying it off as early as we possibly can. However, when I graduated from college, we did pay off our college debt as quickly as we could.
mm,
Maybe not the best idea, but we actually delayed investing in order to knock those out as quickly as possible. And so we paid off all of our student loans within 7 years of graduating. And
wow,
so we no longer have them, and it's a huge weight off of our shoulders. I have people that I know that do still carry large amounts of student debt, and for some of them, it's incredibly stressful, and it's a constant weight on their shoulders. And even if they have low interest rate, the psychological impact and benefit of paying those off is definitely felt.
yeah, I love hearing these examples. Um, you know, this ties into the kind of the naysayers, right? What are some of the risks of choosing to pay off debts more aggressively as opposed to investing it, right? And that's you'll often hear people. Um, I get a little bit frustrated on this. Perhaps certain YouTubers or loudmouths or uh, other financial gurus out there who will very aggressively say like, you are stupid for paying off debts. Like, do you have any idea the future returns you could get in the markets, that you've missed out on all these potential gains by paying off debts? You should just, invest. I've always viewed that as an idealistic view rather than a pragmatic one, because for most people, uh, it's very difficult to just invest everything in the markets and be able to ride out that storm
Yep,
and
that
have no
volatility.
psychological. Yeah, and it's just not pragmatic. And there's overwhelming evidence that supports this case, right? That there's all kinds of studies out there by different places. Fidelity, Dalbar, think, is one where like they show investor returns compared to the actual benchmark returns, like what investors
Yep.
would have earned if they didn't allow their emotions to cause them to
What it
to
what
buy
is
in
it?
and sell out.
What is it that Americans are at right now? An average 1 or 1.5% on their returns, because they're buying high and they're selling low, right? They're buying in when there's market fervor and greed, and then selling out when they get scared. And again, paying off your
Gosh,
debt beforehand and maintaining that properly funded
yeah,
emergency account is going to allow you to ride out that volatility, buy when it's low, buy when it's high, just keep
yeah,
carrying on.
yeah. I've always wondered if having a well-defined and established emergency fund and paying off debts for many people could be the key to being able to ride out those markets and actually not be one of those people who um, has these tremendously low returns in the markets due to emotions. If they had taken some time to
I certainly
set themselves
I
properly.
certainly think so. We right, we've paid off all of our debt except for the mortgage. No more student loans, no credit cards. We paid off
Mm-hmm.
for the first time ever back in 2018. We bought a brand new car. Before that, every vehicle we owned had more than 100,000 miles on it. So for the first time ever, we bought a new car, put nearly 50% down, and then paid the rest of it off in under 18 months. I hated having a car loan, but now that we have paid it off, feel great about having the car. The car actually has as much value now as it does when we bought it, which is pretty crazy. And not how cars usually work or depreciate.
Yeah.
But having gotten rid of all of the debt except for a low rate mortgage allows us to weather out the storm, and it allows me to go, oh, the market's down 25%. Well, I'm going to buy, right? I don't have to jump out of it. I want to accumulate more when it's dropped like that.
Right.
And I can only do that because we've cleared our debt.
Yeah, that's a great personal story, Danny. Like all the benefits. I mean, I think the key from the takeaway from this part is for our listeners, if you go through this process and you come up with a intentional, deliberate, compelling reason to pay off debts, like you've put thought behind it, you have some type of logic or rationale that supports that decision, then you are not stupid for paying off additional debts. I get frustrated when people call other people stupid for doing that. You are not stupid. Beware of dogmas out there, right? Even in amongst financial advisors, there's a certain dogma around there. It's just like, oh, don't pay down the debts. Just make your regular payments towards your mortgage and just invest the difference. When you put a little bit of scrutiny to that idea and you go through this process, it starts to raise certain questions. I just don't know if one is being intellectually honest about this. I just don't think it's that simple. Financial advisors are also, think about conflicts of interest, right? A lot of financial advisors are paid to have assets under management. So
that's true.
Taking money out of your account to pay off a mortgage or pay additional debts reduces their potential compensation, right? And so, not that there's anything wrong with assets under management, and there are obviously tons of amazing advisors out there who put their clients first, but these things are baked into the zeitgeist, if you will. Like,
okay,
they do affect advice and rules of thumb and certain dogmas that people follow. Paying off additional debts can be a very viable strategy when thought of in this way. We're not saying, just to recap our thoughts here, Danny, we're not telling you, our listeners, that you should just go pay off all your debt. That's not the takeaway. That may or may not be the best strategy for you. I think talking to a professional or going through some exercises yourself and asking yourself these questions is going to help you come to that decision. The point we're trying to make is that paying off additional debts gets glossed over, right? It's oftentimes just kind of put in this category of like, just invest any free cash flow. And the point of this episode is we want to make sure that you have time and put enough thought and intention to explore this concept in a more meaningful way.
Yep.
And I think that's all I had to say on that topic.
Okay, that makes sense. You can certainly, everyone listening can take a look at their debts and look at the rate they're paying on it. There are plenty of useful tools online, like additional mortgage payment calculators and additional debt payment calculators that will let you know if you make additional payments, how much interest and money it will save you over the length of the loan. And once you've used those and entered all your numbers, you can essentially make an educated decision regarding what kind of return you'll get paying off additional debt versus investing.
Yeah, absolutely. And to all of our listeners, hope you found something useful and some good takeaways from this. And as always, thank you so much for joining us. Danny, good to see you again. And we will see you all next time.
Chris, it's been great talking to you. Thanks for walking us through this topic. And as always, everyone, have a great week.